Welcome to the December issue of CapWealth On. Joining me today is Grant Stark. He's a familiar face, and I brought a new face with me, Drew O'Connor, who's in charge of trading for the firm. We'll give them both an opportunity to talk about how we manage our investment process and some of the things that are currently going on in the financial markets. I'll start by saying everybody has an opinion. And yesterday, the Federal Reserve reported that they're going to take a pause in increasing interest rates. But at the same time, they also declared that it's too early to announce a victory on inflation. And that opinion is coupled by a lot of other opinions. And what you essentially pay us to do is to help you manage that risk in generating a return on the things that are important to you based upon what you tell us about what your objectives are. And that's not always an easy task. And so our opinion is really a synthesis of a lot of other opinions from people that we respect. For example, the idea that inflation is under control, we're not buying it. The consumer price index is still 3.1%. But when you add back in the things that you and I buy, food, housing, transportation costs, inflation is still closer to 4%. And that is echoed by, for example, Jamie Dimon, the CEO of JP Morgan. He believes inflation is going to be far more persistent and persistent for longer. Henry Druckenmiller, one of the most respected investors of our time, believes that inflation will be higher for longer, and it will be coupled with persistent problems related to the federal budget deficit. For example, just the month of November alone, we had $80 billion in interest expense. We've got a $34 trillion national debt, and next year, in addition to financing and refinancing that $34 trillion, we're going to add an additional $1.7 trillion in expense. That concerns Henry Druckenmiller. It concerns us, and probably someone that we have the most respect for because he manages a larger percentage of bonds probably than any other single manager in the world, Jeff Gundlach. Jeff Gundlach actually predicted this short-term drop in rates. He called it a Pavlovian response to a slowdown in the economy. And he believes that inflation will be higher for longer. And in addition to that, the tremendous demand on refinancing the debt will crowd out other investments and force the Federal Reserve to raise rates and keep rates higher than what people are anticipating. Even now, as the 10-year Treasury is at 4%, if we were at 2% inflation and we're not, the 10-year Treasury priced for history would be somewhere around 4.25% to 4.5%. So we incorporate all that into our investment policy, and we focus on individual companies, individual strategies that will reflect that. So in the last few years, because of all these factors related to inflation and runaway deficits, we've been more focused on controlling risk, at the same time generating a reasonable level of return. So that puts us out of phase with the rest of the market. So that's enough about that. Grant, this is, a return appearance on CapWealth On. Why don't you talk a little bit about how we manage some of the difficult challenges that we have when you're doing individual securities. Ted Jones, when I was first started in the business, he said, if you're in the cattle business and you got 300 head of cattle, every once in a while, one or two of them will die or get sick. That doesn't make the business bad. It's just part of the nature of that. So talk a little bit about that process and of how we manage difficult securities and difficult situations when companies just don't meet our expectations.
Sure, Tim. Well, thank you, and good to see everybody again. like Tim mentioned, it's the nails that stick up the highest that hit the hammer hits the hardest. And, there's always going to be one or two in a portfolio. A good example of this that we can sort of break down is our trade with Intel and Pfizer. About a year and a half ago, when we swapped most of the client accounts that had Pfizer into Intel, we looked foolish for quite a few months as Intel traded lower than our purchase price. But when we reflect back today, it's a really good example of our consistency in our process, in our research process, in our thought process, and in our leadership process with our portfolio consistency. And what that means is Intel now today is trading up almost double from where it was at those lows, while Pfizer has floundered this year, significantly lower as there's been market pressures on the company. And so when we did this trade, not only looking back, have we crystallized a tax loss to shelter some taxes for clients, but we're sitting on a very good trade of Intel that we expect to hold for the foreseeable future. And what's tough about consistency in these processes is we need to focus on the thesis. We need to understand the thesis. And between Tim, myself, and Drew, we really talk through this as a group. We talk through this as a firm, as an investment committee, and make sure that what we're seeing in the balance sheets, what we're seeing in the financials is sound, and then our thesis is sound. When we look specifically at Intel, I would just mention, Tim, it's a great example of onshoring of American power, where we need to build chips in the U.S. We saw this about 2 years ago, that we needed chip leadership again. Gone are the days that Taiwan will develop and produce 80% of the chips of the world. Between Ohio, Arizona, and a few other states, we're going to be now a leader in chip manufacturing in the next few years. And so that type of tailwind at our backs is exactly what we're going to look for in these companies that can weather unforeseen inflation, higher interest rates, and get through the type of economic uncertainty that Jeff Gundlach and others are trying to weather as well. And so, Tim, I would just close with, these are the types of investments that we're going to build around. And we may have had a sticking out nail of Intel last year, and that looks like Lumen today. And so when I look at Lumen, I say, geez, there's a massive fiber network there with value. And even though there is some uncertainty in the stock, we're going to keep consistency there and continue to research this business and see it through to the other side.
Yeah, we won't hesitate to admit when we've made a mistake, but we also stand on our conviction. One other thing I'd add, we take a lot of feedback. Phoebe Venable, CEO of the company, and Jennifer and Hunter and Hillary, who you all work with, we get feedback from them. And what we hear from you gives us insight as to how we can better communicate these difficult and controversial comments, because you're not always going to get, and most of the time, you're not going to get good news and accurate news, on the TV programs about financial markets and strategies and things like that. So again, with our focus on risk and generating reasonable returns, that's somehow lost in the excitement that people have and the fear of missing out on some big new trend. So I want to ask you, Drew, to comment on a couple of things. Drew, just to give you an introduction, Drew's a chartered financial analyst. And you've heard me speak about that before. We have 3 chartered financial analysts in the firm. We pride ourselves on having strong academic backgrounds. For example, Phoebe has a degree in math. She's got a master's degree in economics. She's a charter holder. Grant is a charter holder. Drew's a charter holder. And and we have an analyst in training right now that's sitting for his CFA, to become a charter holder. It's a very, very difficult degree. No one typically passes each of the 3 legs of it the first go around. And I believe it's even more valuable than a master's degree in business or finance, certainly from some of the universities in the United States now. So that being said, Drew is also going to be in charge of incorporating the use of artificial intelligence into our daily workflow and the opportunities. I wouldn't expect much from that, but it would allow us to, use some of our processes that we've developed and some of the institutional knowledge over the years into better overall results and consistency for you. So Drew, why don't you let's just take one aspect of what you do for us on a daily basis in handling all of our trades, the regulatory compliance for it, and just explain to the viewers, for example, how are you, if Grant and I say, hey, we're going to sell 30,000 shares of Intel across the board, tell us how you get that done and how you allocate that to each of the client accounts.
Well, thank you both, Tim and Grant. So our trading process allows us to have the opportunity to trade and scale. In a nutshell, bulk trading is a process where you can essentially take every client account trade of the same security and consolidate it into one. What does that basically mean? In a scale trade like a bulk trade where there's a large quantity of shares, we have the opportunity to trade through our custodian, Charles Schwab, who allows us to work a trade in over time and be able to fill the trade before the close in order for every single client account to receive the same trade. That gives us the opportunity to utilize an average price account to basically allocate a trade once it's done being executed to allocate to every eligible client account, and every client account receives the same price. So in a situation where we did the Pfizer to Intel swap, both of those trades were bulk trades because of the size of the trade in total of all the shares that we held in Pfizer and wanted to buy in Intel respectively. So selling a trade like Intel, selling 30,000 shares, it might not just be as simple as executing the trade and then allocating it to a specific account or multiple accounts, but there's also other consequences out there, such as tax consequences. So in our selling process, we take the tax lots into consideration, whereas an opportunity to potentially sell the lot at the highest cost to be able to optimize an opportunity to tax loss harvest into, say, at the end of the year, which is a common practice.
So let me interrupt and ask you a question. So if we've got a client, let's say they've got multiple purchases of Pfizer, and let's say they paid $50 for some, and the price is $55, but then they also bought some at $40. That process you just described allows you to sell the higher shares and take a loss at the same time that you preserve that capital gain. You can recognize the capital loss and preserve the capital gain for a future date.
That is correct. So when prioritizing highest cost, whenever you're trying to take a loss at a given time frame, that opportunity is there for us to be able to utilize that benefit of saving taxes for our clients, and we continue to do that over time.
When I started in the industry over 40 years ago, and we didn't have this process in place, you can imagine if I had 100 clients that we were selling Intel for or buying Intel for, how do you allocate that equitably based upon calling them? You know, do I call my best friend first and at the end of the day, my least favorite client? No. So what this does, it allows us to create some consistency and equity in how we do it. Tell them about, let's say you were going to buy Intel on a day that we were buying Intel for the clients. How does that work?
So we prioritize all client trades before our own and employees. So any client that is receiving a trade that day, that will always be prioritized during the market hours. Day in the open at 8:30 through 3 p.m. in the afternoon. Client trades are always prioritized no matter what.
That's terrific. And so that gives you just an idea of how we functioned. So with that said, I want to thank both of you for joining me today. Thank you, valued client, for taking the time to listen in, and Happy New Year, Merry Christmas, and we will see you again next year.